Okay, everybody, we're going to go ahead and get started. Can everybody hear me loud and clear?
Yes. Yes.
Okay. All right, perfect. Thanks a lot. Again, we are experimenting with streaming these live to YouTube and Periscope and that sort of thing, so bear with us. Hopefully everything goes smoothly this time around. Today we're going to talk about crude oil trading. We're going to talk about actually analyzing the market, not necessarily trading it, although they do come hand in hand. But we're going to talk about the seasonalities of crude oil, the reading the COT report, and basic chart analysis and that sort of thing. We're actually going to look at a current chart and kind of see if we can guess where crude might be going next. Is it going to 100? Is it going to 35? Let's see if we can find out. Okay, if you're unfamiliar with us and what we do, my name is Carley Garner. I am a futures and options broker in Las Vegas, Nevada. We run a service, it's called DeCarley Trading, in which we provide brokerage services. So we offer everything from full service to discount online trading and everywhere in between. Most of our clients do trade online, so we set them up with a trading platform that's appropriate for their needs. But what makes us different than most brokers is we give trading guidance, advice. We answer our phones. I know that's not necessarily, seems like such a simple thing, but not most brokers don't answer their phones. We do. We try to get back to everybody by email and text message as soon as possible. So our goal is to provide the best possible service at reasonable commission rates. If you're on social media, you can check us out on Twitter, Facebook, Instagram. I post a lot of dog pictures on Instagram, so if you're not a dog fan, you might want to skip that one. But we try to post market commentary, charts, examples of our newsletters, make sure everybody's aware of any events such as this. I'm a little bit of everything, but I'm a broker, a strategist, and an author. I do write a column for Stocks and Commodities magazine. It's called Futures for You, if you've ever picked up the magazine. It's actually a great magazine. Unfortunately, magazines are, you know, there's not as many, let's just put it this way, there aren't as many magazines as there used to be, but Stocks and Commodities is a really, really good one. And I've been associated with them for a long time. I want to say probably around a decade now, so things have been good. I also contribute content to Jim Cramer's Mad Money. We roughly about once a month or so, we provide content analysis, crude oil, gold, those types of things. And if you do happen to be a client of ours, we write in-house newsletters. Some of them, well, one of them comes out daily or nearly daily, depending on what's going on. Sometimes it's only 3 or 4 times a week. The DeCarley Perspective, we try to pick a commodity market once a week and focus on it and drill down what's going on and fundamentals and technicals and all those sorts of things. And this is new. We do now have an app. This is not an app for trading, although our clients do have access to their accounts on their mobile phone where they can actually trade. But this particular app, the DeCarley Trading app, you can get on the Apple Store or the Google Play Store. And it's not for trading, it's for information. So we provide our clients with access to the newsletters. Trading recommendations come as push notifications, all those sorts of things. So if you're interested in learning more about trading or getting an idea of the kind of services that we provide, this is a really great tool. And basically, you have us in your back pocket. You can contact us immediately through the chat feature and that sort of thing. I've also written a couple of books. If you like anything that we talk about today and you want to learn more, the best place to start is A Trader's First Book on Commodities. That's the ground level. That's like ground zero for learning how to trade commodities. And then higher probability commodity trading takes it a little bit further. We start talking about oil analysis, that sort of thing. We'd obviously love for you to pick up a copy of the book, and if you have questions or anything, you can feel free to shoot us an email or give us a call. Anyway, let's get down to it. Before we start, I just want to make sure you understand that there is a substantial risk of loss in trading futures and options. It's absolutely not easy. It's difficult. If it were easy, everybody would do it. Some of you I know that in this class I've spoken to before, and they're not necessarily crude oil traders. Some of you trade stock indices or trade other markets, but the reality is, even if you don't actually trade crude oil directly, you're trading crude oil indirectly. And this is even true even if you're not trading futures, even if you're only investing in mutual funds in your 401k, you're still, in a roundabout way, involved in the crude oil market. Crude oil plays a huge role in all of our lives. We all know this. The stock market actually does move with crude oil. Sometimes that correlation changes. When I first started in this business in the early 2000s, there was a negative correlation. The thought was if crude oil prices were higher, then that would be a drag on the economy. So the stock market would sell off. When crude was trading over $100 a barrel, you could almost watch it tick for tick. If crude oil started moving higher, stocks down, and so on and so forth. And that was kind of the pattern. Any big update in crude oil, you could almost bet that you'd look at the S&P quotes and see that the stock market was down. It's actually flip-flopped in recent years. So crude oil and the stock indices tend to have a positive correlation. This has faded a little bit now that crude's kind of out of the limelight, but there was a time a couple of years ago, if you remember, when crude oil was trading down in the low 30s or the high 20s, and everyone thought the world was coming to an end. Every day that crude oil went down, it dragged the stock market down with it, and there was a lot of stories behind that. The debt market, the junk yield market, or the high yield market, the junk bond market, a lot of those loans were tied to crude oil, and so as crude oil sunk, there was some risk of contagion. You know, if a lot of the junk bonds defaulted, was it going to take the economy down with it, that sort of thing. But also, the U.S. is such a huge producer of crude oil now. When crude prices get cheap, what happens? Oil producers lay workers off. And I can speak firsthand because my family's been in the oil business for a long time. Crude oil jobs are very high paying and the barrier to entry is relatively low. So it's actually a really great resource for the U.S. economy. So when crude prices tumble, it now actually hurts the stock market. And of course, there's other things that impact our lives, like gas prices. I think we all pay attention to gas prices. But you get the idea. Even if you're not actually trading crude oil, it's a really good idea to just be aware of what's going on in the markets. Now, a lot of people like to talk about crude oil fundamentals, probably because that's the easiest thing to talk about. If you're looking at the TV news stations, reading the Wall Street Journal, it's a lot easier to write about fundamentals than it is to write about weird things like the COT report. So that's what people talk about. But the reality is, trying to use fundamental analysis and applying that to your trading strategy is really, really difficult. I'm going to show you a chart in a few minutes and you'll see exactly why. I mean, ultimately, fundamental analysis is built on two very, very simple equations. If demand is greater than supply, prices should go up. If supply is greater than demand, prices should go down. We all learn this in finance, or even even high school. I think a lot of high school classes taught you that. It seems really simple on the surface, but the reality is it's not that simple. And the reason being, we don't get accurate, real-time, quantifiable figures. It seems like we should be able to, but we just can't. And if you're working with numbers that are lagging in time or lagging in, lacking in accuracy, that undoubtedly means that the numbers that you're putting into the equation is basically garbage. And when you put garbage in, you're going to get garbage out. So trading on fundamentals is really difficult. In my opinion, these seemingly simple formulas become confusing at best, but misleading at worst. In fact, I think they're probably misleading. In my opinion, I believe traders are better off combining different types of analysis. For example, using fundamental analysis in combination with chart work, seasonal patterns, the COT report, and market sentiment. And that's what we're going to talk about today. On a side note, trading solely on fundamentals requires much deeper pockets and steadier nerves than most of us have. Trust me when I say this. And this chart explains exactly that. If you were trading crude oil in 2007, you probably remember crude oil being $140 a barrel, and it actually peaked out around $150 a barrel. It didn't last long, but at the time, when crude was at 140, almost 150, you could not find an article out there that was bearish crude oil. Everybody was bullish crude oil. All you read about were peak oil concerns. We're running out of oil. It's a limited resource. What are we going to do? And just about the time that some of the big banks and well-respected analysts put out their target of 200 to 250 in crude oil is when the market topped out. So we never saw $200 crude oil. In fact, it dropped from 150 into the 30s, and it did it in 3, 4, 5 months very, very quickly. If you're unfamiliar with crude oil, a move like that is worth roughly, well, let's just put it this way. Each dollar that crude oil moves up or down, a futures trader is making or losing $1,000. So a trader on this move could have easily, if they were in for the whole ride, they could have easily made or lost $100,000 to $120,000 in a couple of months on one contract. To put that into even more perspective, the margin on crude oil is, well, we'll just call it 5,000. Right now it's actually closer to 3,000. At the peak it was quite a bit higher actually. I think it got into the $11,000 or $12,000 range. But you can see what I'm talking about here. With so much leverage, people can really, really get hurt. And this is an important thing to note if you're an option seller. It's really easy to get lulled into markets, and I'm not just saying crude oil, but any market in general that's trading relatively quiet. But it's important that you keep an eye on the big picture, because although crude has been quiet, if we look at just the last few years, it seems relatively harmless. There are times where it's far from harmless. But the point of this slide is, at the lows was during the financial crisis, and we all remember during the financial crisis, and this is true whether you're trading stocks or crude oil or whatever the case was, when all of these markets and all these asset classes were near the lows is exactly when everybody assumed that it was just going to keep going. Nobody thought the S&P was going to rally from 777 or whatever the exact price was, but if you look back, they probably should have. I mean, that was ridiculous. And crude oil should have never gotten to $35 either. That was ridiculous. But at the time, it seemed perfectly rational because that's what everybody was talking about. The fundamentals were telling us to be bearish crude oil, to be bearish stocks. But again, fundamentals really generally lag the market overall. And in fact, the markets tend to really overshoot fundamentals to ridiculous levels before reverting back. And that's exactly what we saw. So fast forward into 2016, some of you might remember when crude oil actually dipped into the high 20s. At that time, it was the same thing. Everything you saw on TV or on the internet or in newspapers, everybody was looking for crude oil to get into the $10. They were looking for 80s era crude again, $10, $15 crude. And the story was, we had a massive supply glut. And that story was true, but again, when everybody's talking about a specific story, it's probably already priced in. If any of you are familiar with Dennis Gartman, he sells a commodity newsletter for a lot of money per month. I don't want to put anyone on the spot because we all make bad calls from time to time, but he tends to be wrong more than he's right, or at least that's been my observation. He actually came out on TV and said when crude oil was around $27 a barrel, which happened to be the low a couple of years ago, he said something to the effect that we will not see crude oil above 44 again in my lifetime. Luckily, he's still alive, but crude oil is well above 44. So he definitely got a little carried away with the fundamentals on that one. So now the story that we're all hearing is OPEC supply cuts, all of these things. The fundamentals aren't nearly as bearish as they used to be. But the reality is there's really not any less crude today than there was in early 2016. I mean, honestly, you could argue that crude oil should probably fundamentally be down in the 40s or 30s. And I think my opinion is I think that is eventually where we'll go. But markets are emotional, and for now the trend is up, and that's how things are going. So we'll take a look at a chart in a few minutes to just get a better picture. But I just wanted to make sure we're all on the same page here of just how difficult it is to trade fundamentals. And what I mean by that is if you're watching TV and reading the newspaper, don't necessarily let all those stories get into your head because there's a lot more to it. So if you are going to trade fundamentals, or even if you're not, I really highly recommend that you're aware of the reports that come out in the crude oil market because they do change prices, and they do change prices pretty quickly. So of course there's annual forecasts by the EIA. Honestly, they're probably wrong more than they're right, but something to just be aware of. The ones I really want you to focus on, though, are the weekly inventory data. These are the reports that traders are really looking at, and these are the ones that really turn the market in the short term. In fact, we've seen some pretty good reversals on the inventory reports, so you want to be aware of them. The API, the American Petroleum Institute report, comes out Tuesday evenings. It's only available to subscribers, so if you think you're going to get it for free, think again, unless you have a buddy that subscribes. Some people believe that their measurement tactics are far more accurate than the government's, which is the EIA. The reality is both institutions or both entities are giving out different data, and it's supposed to be on the same they're supposed to be studying the same thing, which is crude oil stocks in Oklahoma, but they really come up with slightly different answers, and so who's right and who's wrong is anybody's guess. I tend to think that the government's probably less accurate, but I could be wrong. And of course, we should be aware of OPEC. OPEC has far less influence on crude oil prices than they used to. Some people might even say OPEC has been fracked along with U.S. shale, but they do still account for about 2/3 of the world's oil reserves and about 1/3 of the production. So they still have some clout. If they are making moves or chattering, the market does move. So be aware. That said, as time goes on, at least according to the U.S. government, they believe U.S. shale producers will be the largest producer of oil in the world within the next, I think they said 4 years, if I'm accurate on that, but maybe it's 5. In any case, the U.S. is on its way up and OPEC's probably on its way down. So OPEC's days of manipulating prices are probably behind it. So let's talk about crude oil seasonals. Sometimes it's easy to overlook seasonal patterns because you're caught up in the day-to-day news stories and that sort of thing, but it's very important to be aware of cyclical stories. In crude oil, there are certain times of year that the market goes up and the market goes down. It doesn't always do that, and that's true of any commodity. Commodities have patterns that they normally follow. It's not a guarantee, but you probably don't want to consistently go against it either, so be aware of it. The energy markets seem to have some of the more reliable seasonal patterns, but because energy markets are volatile and there's a lot of leverage built into the market, it's not quite as easy as making money on them as you might seem. But let's take a look at whoops, I got a little carried away. Here's a seasonal chart of crude oil. This is actually cash crude, so it's slightly misleading. If you look at the seasonal charts of individual futures markets, they might be a little bit different than this, but the point of this is to give you the overall idea so that you're not heavily selling crude oil in early February or being super long in late July. Refineries generally demand crude oil early in the year because they're anticipating high demand for summer driving season. So a lot of people think that they should buy crude oil during the summer because of the driving season and the additional usage, but that's actually untrue. You should be buying crude oil earlier in the year, February preferably, in anticipation of that summer driving season, not during the summer driving season. That's really not how it works. Likewise, it's generally not a good idea to get overly bullish or to be holding a big long position in late summer in crude oil. Specifically in October, it's a really bad time to be long crude oil. Also, be aware of market sentiment. Most traders lose money. That's an indisputable fact, unfortunately. So, if most people lose money, why would we follow the herd? You probably shouldn't, is the reality. Be careful jumping on a bandwagon, particularly in oil, and this happens a lot. There's a few things you can do to make sure you're not following the sheep into slaughter. Tab the board for clues, read online forums, whether it's Facebook or Twitter, and I'm not saying that social media is like the greatest source of information on trading, because it's absolutely not. But what it does do is it gives you an idea of what others are thinking, and remember, most people lose. So if you happen to catch a whole bunch of traders that think crude oil is too expensive or crude oil is too cheap, then you probably, you can take that as a hint that maybe the sentiment has swung too far in one direction. What I like to look at, though, is the COT report. It's the Commitment of Traders report. It's issued by the CFTC, the Commodity Futures Trading Commission. And it basically compiles data on traders holding positions in the commodity markets. It splits them into two categories, the reportables and the non-reportables. Reportables are basically large traders. Non-reportables are small traders like us, the dumb money. You're probably really going to hear when people talk about the COT report, they really don't refer to them as reportables and non-reportables. What you generally hear is the three large categories. So you generally hear commercial hedgers or just hedgers, large specs, and small specs. The large specs are traders that are attempting to predict price changes and make money on speculation, and they are considered the smart money. But as we will find out in a slide or two, they're not always as smart as they think they are. We are the dumb money. We generally are wrong. The small speculators are generally wrong. And when I say dumb money, I'm not saying that we're dumb or we're guaranteed to lose. But the reality is people that are trading smaller retail accounts tend to lose more money than those trading large retail accounts. We can argue as to the reasons as why. I would venture to say that most of the smaller traders are over-leveraged. They trade too much, and so they end up making bad decisions. So the nice thing about the COT report is it tells us where traders are putting their money, not their mouths. To give you an idea of how much you would have to trade to be a reportable or to be a large spec, I believe the last time I checked, the reportable limit on WTI crude oil futures is 350 contracts. So for you to be considered a large spec, not a small spec, you'd have to be trading 350 contracts at the same time, simultaneously. The margin per contract is roughly $2,300, which means you'd be holding a position of $805,000. That would be your margin requirement to hold that crude position. Some of you might be thinking, well, $800,000 account, that's not that big. I could do that, but you really would not want to be long or short 350 contracts of crude oil in an $800,000 account. Your exposure would be out the door. Roughly, you'd be trading, assuming crude was at $62 a barrel, which it's a little higher, but you'd be roughly trading like $22 million worth of crude oil, and that's what would get you into that reportable category. So just so you know, we're small specs, and unless we're trading $22 million worth of crude, we'll always be small specs. So what we look for in the Commitment of Traders report is for overheated markets. We're looking for large speculators that are holding really large positions, whether they're long or short. Generally, if the large specs are massively long or massively short, it's generally a sign that the trend is coming to an end. In other words, everybody's already acted, so buying or selling dries up and it causes the trend to violently reverse. And so basically, in a nutshell, if everybody that's bullish has already bought, who's left to buy? It's really that simple. And when these types of things get overextended, when everybody's bought and there's no one left to buy, the market can correct regardless of the fundamental story. Perhaps fundamental stories are still bullish. It really won't matter. The only thing that matters is everybody's long, and the only way for them to get out of the market is to sell. So a lot of people want to just jump on the bandwagon. They see where the smart money is, and they just want to go with the flow. And that's probably not a horrible idea, but only when the trend is just budding, not after it's extended itself. Never forget that the large specs, they have much deeper pockets, and they have much more pain tolerance than we do. They can ride out a $10 or $15 move against them in crude oil and probably not blink an eye. Most of us would not enjoy that. So if you're going to follow the smart money, make sure to do it in the beginning of a trend, not the end. What we look at the smart money for is not necessarily what direction are they going, but how big of the position do they have. So this is a good example of the clues that the COT report might give you. So for example, prior to the hideous decline of 2014 in crude oil, large specs were holding the largest net long position in history. They've actually dwarfed, and that's right here. So large specs were as long as they had ever been, right before one of the largest crude oil declines. That doesn't make sense, right? If they're the smart money, why the heck were they holding massive long positions just before the market fell out of bed? Well, I mean, I can't answer that question, but I think it's really almost as simple as if everybody's long, the only way to get out is to sell, and so they do. And when the market starts going against them, then it's not a question of do they want to sell, it's a question of now they have to sell, and they have margin calls, and you get this cascading of pricing. Ironically, near the 2016 lows, specs were the least bullish that they've been in over a decade. So you'd think, remember we were talking about Dennis Gartman said we'll never see oil at 44 again, when at the time crude oil was in the high 20s, you would think the smart money would be piling on long positions, but it was the opposite. They weren't short. If you notice, this zero line here is actually the difference between long and short. So they were still long crude, but they were the least long they had been in decades, right before the market bottomed. Now, keep in mind, these things take a long time to play out. For example, the longs were a little over zealous here for months before the market finally fell off as a weekly chart. So this is probably a month, month and a half of just trolling the lows before this finally worked out. So it's easy to look at a weekly chart and say, well, duh, of course you should have been long there or short there. But somebody that's trading on a day-to-day basis or has, some options out there that are taking some heat, it's really, it's a little bit more difficult when you're trying to ride this out than it is looking at a weekly chart. So sometimes it's good to basically just take a step back and look at the big picture, and that's exactly what we're doing. So somebody's asking, are specs always long crude? And the reality is, yeah, they're almost always long crude. Crude's one of those markets that generally can go up faster than it can go down, although there might be a good argument for that in this particular case. But more often than not, crude oil is more explosive to the upside. And so the market or the speculators tend to have an upside bias. They're almost always long crude oil. So yes, that's true. Right now, we are holding the longest, and it's actually tapered off. You can see right here, it's tapered off in the last week or two. But we are seeing the biggest bullish position ever in the history of crude oil futures right now. So in my opinion, there's probably only one way this can end. I could be wrong. Maybe magically somebody will show up and have enough money buying power to force prices higher. But generally, when you see the COT at this extreme, and actually we've never been to this extreme, but when you see the COT report at an extreme, such as this, it's really difficult for the fundamentals to carry the market higher. So I'm not saying we sell off $20 tomorrow, but I'm saying there's probably a lot less potential on the upside than there is the downside. If this group of traders finally starts to liquidate, then we could start seeing prices back into the 40s pretty easily. I wouldn't be super shocked, although I'm not going to call that today, but I wouldn't be shocked to see 30 again. But for now, we'll stick to maybe the 50s or the high 40s and see where it goes. Okay, and a lot of people completely disregard the US dollar and what it matters to commodities or the price of crude oil. Currencies do matter. Too many traders ignore it, but they really matter more than we all want to admit. Crude oil is priced globally in US dollars. Thus, it's highly dependent on action in the currency markets, particularly the dollar. If the dollar moves higher, it puts pressure on oil prices. If the dollar moves lower, it pushes oil prices higher. And this is true. It does not matter what fundamentals are going on, what's going on in the world. This is just the truth. And this chart proves it. You'll notice that the green, by the way, the green is the dollar index, the US dollar index, and the black is crude oil. So you'll notice at every big inflection point, every big peak in the dollar, you see a trough in crude oil, or a peak in crude oil, you see a trough in the dollar. And this happens over and over and over throughout history, yet not many people really talk about it. When we saw the massive dollar rally in 2014 and the massive crude oil collapse, everybody was talking about the crude supply glut. There's all these stories. But look, maybe it was just as simple as the dollar went up. So maybe all these stories, these fundamental stories are wasting all of our time. Maybe it's really just as simple as currencies. So in the short run, it's important to notice, like you'll see some of the time the markets kind of go independent of each other and do their own thing, and that could be explained by some fundamental stories or things like that. But on the really big moves and the really big peaks and troughs, you're going to see that they move together. They bottom together and they top together. I see that there's some questions popping through. At the end of the class, I'll scroll back and try to make sure we get all those answered for you. Okay, so let's take a look at the chart. This is a weekly chart. Remember, we talked about the benefit of just simply taking a step back and looking at what has developed over the long run. Anybody that's trading crude on a day-to-day basis is probably, I don't want to say shocked, that's not the word, but probably a little surprised that crude's moved so quickly in a short period of time, because if you look at a daily chart, it seems like a big move. But if you zoom out and look at a weekly chart, it's really a drop in the bucket and probably doesn't mean a whole lot. I think that we're probably going to continue for now to stay in this little trading range. I'm looking for, again, I should disclose, I could be wrong. We do our homework and we make the best guesses we possibly can, but ultimately we don't have a crystal ball. It would be nice, but we don't. I believe that crude oil is probably going to go a little higher before it goes lower. Because of this weekly chart, I have a propensity to believe that crude's going to retest resistance here. And so this would put crude somewhere, depending on how quickly it does it. I mean, you know, weekly contracts or weekly charts are a little complicated because they mix each of the expiring monthly contracts, and so it's a little bit messy. But generally, we shouldn't see the front month crude oil get any higher than maybe 66, 67, 68 at the very peak. So look for those types of numbers. If you start seeing crude get into the high 60s, it's probably a good idea to try to play the downside. If you're really conservative, it might be as simple as just buying some cheap puts. By the way, options are actually pretty cheap in crude oil nowadays. I was trading crude back during this stuff, and the options were really expensive, but now they're cheap. So it's almost better to be a buyer than a seller in many instances. And that's hard for me to say because I usually am an advocate of option selling, but crude options are really cheap right now. So as a seller, it leaves you vulnerable if the volatility does come back. It could be hard to keep up with. So just be careful with it. I'm not saying don't do it, just be cautious. So anyway, if crude does get into the high 60s, I think it's probably a time to start looking the other way. If I'm wrong, which has happened before, there really is nothing stopping it until we get up into the, depending on how fast it does it, could be as high as the low 80s. I really doubt that we're going to see that, but it's not impossible. The most likely scenario is we go a little higher in the short term, and then we're probably going to start making our way back to this trend line. I think at some point we're going to break it. It might not be until later in the year because, as we mentioned, we looked at that seasonal chart. Seasonals are actually a little bullish until we get into late summer or the fall. So you don't want to be too excited about that. You want to keep in mind in the back of your head that seasonally the market generally goes up. So if we do head back to the bottom of this trading range and we do break through, then that's when we start talking 40s and maybe 30s. 30s might be a little out of the, it's hard to make a $30 prediction, but I'm willing to say we will see 40s again. I'm not going to say anything as crazy as Dennis Gartman did. I'm not going to bet my life on it, but I do think that there's probably a 75% chance we see $40 crude sometime this year. Okay, so I want to thank everybody for coming out. I hope that you got something out of it, and I hope that it made you think about some things maybe that you hadn't thought of before. If you have any questions or anything, you can, first of all, you can refer to my books. Higher Probability Commodity Trading takes a lot of what we talked about today and expands on it and gives you quite a bit more information on it. Both books can be purchased at any major book outlet, but they're cheapest on Amazon. That's what I recommend that most people. So anyway, if you want to learn more, also we have several trading videos on our website, DeCarleyTrading.com. I'm going to go back through and answer some of these questions now. I apologize I didn't hit them on the way through. I try to, but sometimes it gets difficult. So it's interesting. Somebody mentioned that they keep hearing about how high the demand is for crude oil, and yes, you're absolutely right. We are hearing all kinds of stories about high demand, the economy's booming, everything's going great. But these are exactly the types of things that we were hearing about in 2014 before everything fell apart, and then again in 2007 before things fell apart then. So sometimes when the fundamental story becomes so overwhelming that that's all you hear, that sometimes it's saturated and it's already baked into the market. And so it's hard to set those aside and ignore those types of things, but that's exactly what you probably should do. Okay, so somebody's asking why are we seeing such an increase in the speculative longs compared to history? Where's the money coming from? Well, that's a great question. I wish I could answer that with certainty, but the reality is it's probably a lot of things. I mean, we've had a government that's spent a decade printing money and injecting cash into the economy, and let's face it, assets are really hot right now. The stock market's probably a little overvalued. If you look at real estate in certain spots of certain areas of the country and in Canada, it's a little overvalued. There's a lot of money chasing assets around, and so some of it is filtering into commodity markets and crude markets. We're not seeing the money come into commodities like we did about a decade ago. So we've yet to see that. But sometimes money just needs a place to go, and it finds a place. Whether it makes any sense at all honestly doesn't make sense. I mean, it doesn't have to make sense. It just money goes where they can, where they can find a place to put it sometimes. And you would think that people that have that kind of money would put a little more thought into where they're putting it, but trust me, I see it firsthand. That's not always the case. Someone's asking, is the Brent WTI spread useful in analyzing potential future WTI price directions? I'm sure that it is in some way. I personally have not found any type of edge with that sort of analysis, so I didn't include it today. I know there are people out there that think that they can make predictions based on that, but I haven't found a way. So each their own, though. Okay, so somebody's asking, what would we guess the oil and SPX or S&P correlation might be should we see $40 oil? Well, the last time we saw oil dip down into the 30s and eventually the low 20s, the correlation between the S&P and crude oil got up to, I want to say, roughly around 90%. So it was really, really high. So in other words, out of 10 trading sessions, 9 of them would close in the same direction. So if the S&P was down, crude oil would close down and vice versa. 9 out of 10. So it becomes really, really high if crude oil sells off. As crude oil goes higher, you'll notice the correlation kind of breaks apart. This is the opposite of what we saw in the early 2000s, but this is kind of the new norm now because of the shale oil production and that sort of thing. Someone's asking, isn't demand very high right now and reserves are being nibbled away? And the answer to that is, yeah, that's absolutely true, but that's been going on for a long time, and in my opinion, the market's probably priced almost all of that in. So will that continue to push prices up? It might, but I believe that the upside is probably limited. Someone mentioned that AAA is forecasting higher gas prices. You'll notice that entities or services that really are not necessarily in the business of market prediction tend to basically just go with the trend. So if gas prices or oil prices are moving up, they just assume they're going to continue, and then they throw some number out there above the market as to what their target is. We saw the same thing when crude oil was 150 and everyone thought it was going to 200. You see the same thing in stocks. Remember, just before the stock market correction, everyone was looking for S&P 2,900, 3,000. It was kind of like a foregone conclusion. And then, oh yeah, then they remembered that stocks can go down. Someone's asking, is the COT 90% of fundamentals? I'm not sure I understand that question completely, but I do think that when I analyze a market, I basically break it in. Like when I make a decision, I base roughly 10 to 15% of my decision on fundamental analysis, and the remaining 90 to 85% I put towards seasonals, COT chart, and technical analysis. All right, so someone's asking that if the stock market goes up in April, are oil and oil stocks going to correlate? The pattern has been if the stock market's moving higher, it's kind of drug crude oil up with it. So yes, that is the pattern. As we've already talked about, the seasonal pattern is for crude oil to kind of drift higher this time of year. That said, I still have a hard time thinking crude's going to get anywhere above the 67 or so area. Just fundamentals are really hard to justify up there, but it could happen. So this type of stuff, you have to kind of get your big picture in line, but then don't completely ignore what's going on in the markets on a day-to-day basis, because things can change. But at this point in time, I'd turn bearish in the high 60s. Okay, so I appreciate everybody coming out. So I hope that you all learned something. And again, if there's anything that we could do for you, please give us a call or send us an email. You can reach us at DeCarleyTrading.com. We have a little chat box on the site. You can also find our contact information there. I will get it up on the page for you here. Okay, there's my contact information. If there's anything I can do for you, let us know.